On December 20th, 2001, a helicopter lifted off from the roof of the Casa Rosada while crowds filled the streets of Buenos Aires below. The president of Argentina had resigned. Banks were limiting cash withdrawals. People were banging pots in the streets. And within days, the country would stop paying more than $81 billion of sovereign debt. The question is not why people were angry. The question is how a modern state gets all the way to that roof. From the outside, a national default sounds almost simple. A country borrows too much, then can't pay, then defaults. But that is the cartoon version. The real version runs on clocks, currency, banks, law, and one hidden machine most people never see until it breaks. And this machine is everywhere. Global public debt reached a record $102 trillion in 2024. Developing countries accounted for about $31 trillion of that total. In 61 developing countries, net interest payments were taking at least 10% of government revenue. And 3.4 billion people live in countries that spend more on interest than on either health or education. Sovereign debt is not some niche corner of finance. It is one of the pipes the modern world runs through. In 2023 alone, debt service on external public debt in developing countries reached $487 billion. Since 2020, developing regions have often been borrowing at rates 2 to 4 times higher than the United States. So when a country defaults, it is not just one government missing one payment. It is a signal that one of the biggest systems in the economy has jammed. Which brings us back to that helicopter. What actually failed first? Here is the secret. Countries usually do not pay off their debt the way you pay off a car loan. They roll it. That word matters. Roll it. A government sells a bond for, say, 5 years. During those 5 years, it pays interest. Then on maturity day, the full principal comes due at once. Not in tiny monthly pieces, all at once. So if $10 billion of bonds mature this year, the government often does not wire $10 billion from a vault somewhere. It issues new debt, gets fresh cash from new lenders, and uses that cash to pay the old lenders. Then it repeats the process, year after year, sometimes decade after decade. That means a sovereign default is usually not the moment a country literally has zero money. It is the moment the rollover machine stops. The country still has taxes coming in. It still has schools to run, salaries to pay, fuel to import, and pensions due at the end of the month. But the investors who were supposed to refinance yesterday's borrowing stop showing up at a price the government can survive. That is when the calendar becomes lethal. Once you know that, the whole system looks different. Public debt is less like one giant bill and more like an escalator. You stay upright by stepping onto the next stair before the one under you disappears. Miss one step, and suddenly gravity takes over. Start with the first layer, taxes. Governments collect money from income taxes, value-added taxes, export taxes, corporate taxes, customs duties, fees. That is the base fuel. If a state collects $100 and spends $95 before interest, it has room. If it collects $100 and spends $110, it already needs borrowing just to cover the gap. And when a recession hits, revenue falls fast. Households earn less. Companies report smaller profits. Imports shrink. The tax base softens right when social spending usually rises. Second layer, domestic borrowing. Governments sell bonds to local banks, pension funds, insurers, and sometimes directly to households. This can be steady. It can also be short. The IMF notes domestic borrowing is often reliable, but maturities tend to be shorter. That sounds technical. It is not. Short maturity means the government is back at the market's door sooner. If you borrow for 6 months instead of 10 years, your future is never far away. Third layer, international markets. These are larger, and maturities can be longer, but the money is colder. Foreign investors do not vote in your elections. They do not live with your roads, hospitals, or unemployment. They compare you to every other country on their screen. If US rates rise, or oil spikes, or a neighboring country crashes, your borrowing cost can jump even if your own budget barely changed. The money is global. So is the panic. And here is the question for you. If you were lending to a government for 10 years, what would you care about more? Its speech about the future or its next refinancing date? Then comes the fourth layer, currency. Many countries can borrow more cheaply in dollars or euros than in their own currency. That looks smart on paper until the exchange rate moves. If your government collects taxes mostly in pesos, cedis, rupees, or shillings, but owes bondholders in dollars, a falling local currency makes the same foreign debt suddenly heavier. No new borrowing is required. No new spending is required. The debt just becomes bigger in home currency terms because the exchange rate moved against you. Picture a country that owes $50 billion abroad. If its currency falls 20%, that foreign debt did not change in dollars. But with local money, it just got 20% more expensive. The tax base did not rise 20% overnight. The debt burden did. Fifth layer, the official backstop. This is where the IMF and other official lenders enter. They do not exist to make the country rich. They exist to buy time, restore confidence, and keep the balance of payments problem from turning into a total collapse. Sometimes that works. Sometimes it doesn't. Official money can cover a financing gap for a while, but it cannot permanently fix a debt structure that no longer makes sense. It can extend the runway. It cannot repeal arithmetic. And that is the insider truth. Sovereign debt is not mainly about whether a country is rich or poor. It is about whether the state can keep refinancing on terms that do not blow up the budget faster than the economy grows. Now flip the picture over, because the cost side is where the trap hides. A government's debt burden is not one number. It is a bundle of risks. Interest rate risk, currency risk, maturity risk, political risk, growth risk. If rates reset higher, interest costs rise. If growth slows, tax revenue weakens. If the currency falls, foreign debt gets heavier. If elections paralyze budget decisions, investors get nervous before the Treasury has even missed a payment. The danger is not that each piece is fatal on its own. The danger is that they stack. This is why the same debt ratio can feel manageable in one country and deadly in another. A country with mostly local currency debt, long maturities, deep domestic investors, and a credible central bank can survive levels of debt that would crush a country borrowing short in dollars with thin reserves. Structure matters as much as size, sometimes more. Look at the current burden. UNCTAD says developing countries' net interest payments on public debt reached $921 billion in 2024. Half of developing countries were paying at least 6.5% of export revenues just to service external public debt. That is before fixing roads, buying medicine, or building power plants. And 46 developing countries were spending more on interest than on either health or education. Debt service is not abstract. It competes with the rest of the state. Then there is the banking system. Banks often hold large amounts of their own government's debt. The IMF has a name for the feedback loop that creates the bank-sovereign nexus. If the government looks shaky, the bonds sitting on bank balance sheets look shakier too. If banks look shakier, depositors worry. If depositors worry, money leaves the system or rushes into cash in foreign currency. Then the government, which was already under stress, suddenly has a banking problem on top of a debt problem. That is the part that looks fine on paper. Here is where it actually breaks. The single weak point is confidence in refinancing. Not confidence in some vague, emotional sense. Confidence on a schedule. Can this government sell the next bond? At what interest rate? In what currency? To whom? Before what maturity date? If the answer shifts from yes to maybe, borrowing costs jump. If it shifts from maybe to no, the machine accelerates in reverse. Investors demand a higher yield. Higher yields mean new borrowing is more expensive. More expensive borrowing makes the debt path look worse. A worse debt path scares more investors away. Banks holding the old bonds take losses. Credit ratings fall. The currency weakens. Foreign debt gets heavier. Reserves drain as the government tries to defend the currency or pay external bills. People rush to move deposits. Imports get harder to finance. The economy slows. Tax revenue drops. And remember, the old bonds are still maturing on their original dates. This is why sovereign defaults cascade instead of staying contained. A government bond is not just one liability. It sits under the banking system, the exchange rate, pension portfolios, corporate funding, and the price of future borrowing. When it cracks, a lot of other things suddenly lose their floor. And there is one more brutal distinction between countries and companies. When a company goes bankrupt, there is a court and a legal process. For sovereigns, there is no global bankruptcy judge who can force a clean resolution. Once default happens, it becomes negotiation. Messy, political, slow. Sometimes it drags on for years. Argentina did. Now go back to the beginning. Argentina did not arrive in December 2001 in one bad week. It spent years building the conditions for that rooftop exit. In 1991, Argentina adopted the convertibility plan. 1 peso was fixed at $1. After years of inflation, that peg brought credibility. For a while, it looked like a miracle. Prices stabilized. Dollars came in. Borrowing became easier. And because the exchange rate looked stable, borrowing in foreign currency felt less dangerous than it really was. But a peg is a promise, and promises become expensive when the world changes. By 1998, Argentina had entered recession. Growth weakened. Unemployment rose. Tax revenues came under pressure. Yet the government still had spending commitments, and it still had debt to refinance. A country in recession can sometimes soften the blow by letting its currency fall, making exports more competitive. Argentina had tied that tool down. 1 peso still had to equal $1. So instead of adjusting through the exchange rate, the strain showed up in output, employment, and financing. This is the part people often miss. The peg was not just a monetary choice, it was a debt choice. If your system is built around the idea that 1 peso equals $1, then a devaluation does not just alter prices. It revalues the debt structure, the banks, private contracts, and public credibility, all at once. As the recession dragged on, investors started asking a dangerous question. Even if Argentina wants to honor its debts, can it keep rolling them? That question alone raises rates. Higher rates worsen the budget. The worsening budget validates the question. This is how sovereign crises feed themselves. By late 2001, the stress had moved from bond screens into daily life. On December 1st, Argentina restricted bank withdrawals to 250 pesos or dollars per week per account. That measure became known as the corralito. Think about what that means in practical terms. Your wages may still exist on paper. Your savings may still be visible on a statement. But the system is telling you that access to your own money is now rationed by the week. What do people do when a state rations cash? They stop treating the problem as abstract finance. They run. Street protests grew. Confidence collapsed faster. On December 20th, President Fernando de la Rua resigned and left the presidential palace by helicopter. That image became famous because it looked like a political collapse. But underneath it was a financing collapse. The government had lost control of time. Cash limits, protests, capital flight, recession, and debt rollover stress were all versions of the same problem surfacing in different places. Then came the formal break. On the last day of 2001, Argentina defaulted on $81.3 billion of sovereign debt with private creditors, the largest sovereign default in history at that point. It also abandoned convertibility. By 2002, the cumulative GDP decline from the crisis had reached 19.9%. Unemployment hit 21.5%. Default was not the start of the pain. It was the admission that the old arrangement could no longer be defended. So what was the answer to the question planted at the beginning? How does a country get from a functioning state to a helicopter on the presidential roof? Not by suddenly having no money. In the simple sense, Argentina got there by building a debt system that depended on confidence in an exchange rate promise and constant refinancing in a recession. Once confidence in that rollover broke, the political system fell into the hole right behind the financial one. And default did not end the story. It opened the legal one. In 2005, Argentina launched a major debt exchange, and about 76.15% of eligible debt participated. In 2010, a second round lifted total participation to 92.4%. Across those exchanges, roughly $75.5 billion of old debt was swapped for about $43.1 billion in new face value. That sounds like closure. It wasn't complete. Some holdout creditors refused the deal and fought in court for full payment. Years later, that legal battle would help trigger another bizarre episode in 2014, when Argentina tried to make a payment, but bondholders still did not receive it because of court orders tied to the pari passu dispute. Sovereign default can keep echoing long after the dramatic day itself is over. In 2016, Argentina settled with holdouts in a deal that could total about $12 billion if all accepted. That is another lesson hidden inside the case. Default is not one event. It is a long negotiation over losses, law, and market re-entry. Miss a payment in 1 week. Spend 10 or 15 years living with the consequences. Now zoom out. Argentina was dramatic, but the underlying pressures are not rare. The broader trend today is a world with more debt, higher rates, and thinner room for error. Global public debt at $102 trillion is the giant backdrop, but the more revealing numbers sit lower down. Developing countries' external public debt service reached $487 billion in 2023. Net interest payments hit $921 billion in 2024. In 2023, developing countries as a group paid $25 billion more to external creditors in debt service than they received in fresh disbursements. That means cash was flowing out faster than new money was coming in. You do not need a default for that to become a political problem. You just need a budget. Meanwhile, many countries have tried to reduce one vulnerability by developing local currency bond markets. That helps. It lowers direct exchange rate risk. But it does not remove refinancing risk, and it does not fully insulate countries from global financial conditions. If global rates rise, domestic yields often rise too. If local banks are the main buyers, then the sovereign and the banking system become even more entangled. The vulnerability changes shape. It does not disappear. Here is the good scenario. Imagine a country with $100 billion in debt, an average interest cost of 4%, and long maturities, so only $8 billion needs refinancing this year. Interest costs are $4 billion annually. Tax revenues are growing 6% because the economy is expanding. The currency is stable. Investors believe next year's rollover will clear. That country may look boring. Boring is exactly what debt managers want. Now the bad scenario. Same $100 billion debt stock, but average new borrowing costs jump to 10%. The currency falls 20%, and half the debt is in dollars. Suddenly, the local currency burden of $50 billion in foreign debt jumps hard without a single new dollar borrowed. If $20 billion matures this year instead of $8 billion, the refinancing wall is much closer. Annual interest on just that refinanced slice rises from $800 million at 4% to $2 billion at 10%. That is an extra $1.2 billion a year from one rollover cycle. If revenue growth stalls because the economy contracts, the state is being squeezed from both sides at once. That is how thin the line is. Good scenario, time works for you. Bad scenario, maturity dates arrive faster than confidence. So why stay in this business at all? Why do governments keep borrowing? Why do banks keep holding sovereign bonds? Why do investors keep buying them, even after watching countries blow up in public? Because sovereign debt is not just about yield, it is about control. For governments, debt buys time. It lets them keep schools open during recessions, build infrastructure before taxes catch up, and smooth shocks instead of turning every downturn into an immediate collapse. For pension funds and insurers, government bonds are long-duration assets they need to match long-duration obligations. For banks, sovereign bonds are often core collateral, liquid assets, and a link to the state itself. For foreign investors, they offer benchmark exposure, scale, and sometimes returns that are hard to find elsewhere. For official lenders, they are a tool of crisis management and geopolitical stability. In other words, the economics can look thin, and the system still persists because the real product is not merely interest income. The product is time, collateral, market access, and state continuity. That is also why defaults are so unnerving. They reveal that the state's time machine has limits. A country can tax millions of people, own land, regulate banks, and still hit a wall if it cannot bridge present obligations to future cash flow on credible terms. Modern sovereign finance is not a savings account. It is a rolling negotiation with the future. So go back one last time to the image from Buenos Aires. The helicopter rising over the pink roof. The crowds below. The banks limit withdrawals to $250 a week. The formal default on $81.3 billion arriving days later. From far away, it looks like a story about a country that ran out of money. Up close, it is a story about a country that ran out of refinancing room inside a rigid currency promise, and then watched that break spread through banks, streets, and politics in real time. A country's default isn't really about an empty treasury. It's about a government that can no longer roll today into tomorrow.